raise interest rates quite meaningfully this year to rein in inflation again, and we'll probably see a 50 basis point hike next time. 25, I would say, was a bit surprising, but I think they will continue to go. We're convinced they will do perhaps 175 this year alone, with successive meetings raising interest rates because labor markets are really very strong and inflation is very high. With the backdrop of a new world order, and that is these central banks of the United States, of the ECB, the Chinese central bank, etc., will have to look more at their regional economies, their regional situations, and it will have consequences for the global picture that we have not been used to in the past. We've gone overweight China and the Chinese stock market last week. We took a quite cautious view already last year or after the strong rally, but Chinese equities now look increasingly attractively valued with good EPS or earnings per share growth. For the next 12 months, we see sort of a PE around 11 for Chinese stocks, which is very attractive compared to some of the developed markets.
Hello everyone, welcome to SFC Markets Finance. Since the inflation is still high, the Fed has started to hike rates in March, and the Fed officials signaled they may begin to reduce balance sheet in May. However, more hawkish Fed affect the world. As we are in a new world order, how should we invest in the stock market? Let's welcome Michael Strobaek, the Global Chief Investment Officer at Credit Suisse, to join our discussion. Hello, Michael. Glad to see you.
Well, hello, everyone here from Zurich. Michael Strobaek, Global Chief Investment Officer at Credit Suisse. It's my pleasure to be with all of you.
Let's begin with the monetary policy. How do you comment on the latest Fed decision? Are 25 basis points enough?
I'm not sure it's enough is enough. I think it was a first small step in the right direction. The Fed has been in a difficult situation over the last months. On the one hand, there is material inflation pressure in the US economy, which has been building off post-COVID, and because of the disrupted supply chains, and now also because of pressures on commodity prices, especially because of the Ukraine conflict. So they took a first step, and we still think that of course more is to come. They need to raise interest rates quite meaningfully this year to rein in inflation again, and we'll probably see a 50 basis points hike next time. 25, I would say, was a bit surprising, but I think they will continue to go. We're convinced they will do perhaps 175 this year alone, with successive meetings raising interest rates because labor markets are really very strong and inflation is very high.
It seems that reducing balance sheet and hiking rates will happen at the same time. How will more hawkish Fed affect the market?
Well, they will. I mean, they have if you will, a two-pronged approach to tightening monetary policy, and it is very clear that they are now raising short-term interest rates. This is one of the policy instruments, and we think the balance sheet reduction will begin shortly hereafter. It is already on the way. Markets will, I guess, speculate is it gonna happen earlier than in June, perhaps in May, when they also, again, as I said, will make another rate hike, perhaps even 50%. And this process should occur alongside the rate hiking cycle. Our view is that rate hikes and balance sheets are complementary policies, with balance sheet rundown helping to communicate the Fed's intentions to tighten fiscal conditions. And I think as long as this path is well flagged, markets can cope quite well with it. Markets don't like surprises, they don't like uncertainty. And I think the Fed is very clear about its intentions to both raise interest rates and reduce the balance sheet size.
The Fed mentioned that the inflation will fall this year. According to your research, when will the inflation begin to fall?
We think it will begin to slow in Q2. The current commodity price shock, however, raises the upside risk for inflation in the very near term. We need to see, I don't know how to say it, peaking of the situation in Ukraine in a sense of not further escalation. And that is the uncertainty right now on the inflation front. The outsized temporary factors, as they fade, inflation will begin to come down. However, the long-term drivers we think are here to stay, and we think inflation will remain above the levels that we've been used to before the pandemic. And those sort of long-term drivers are, on average, more tighter labor markets, maybe structural shifts because of the COVID pandemic that hits mostly low-paid workers. And those factors are not going to go away so fast. Actually, they could become permanent, and therefore we could see higher levels of inflation than before. But we do expect a normalization as we sort of go into Q2. And the wild card here really right now are energy prices, which are very, very volatile. We read news every day about the effects of the conflict on either oil supply to Europe, gas prices, of course, being the really big question mark as to what's going to happen there, depending on how the conflict plays out in Ukraine. But we do see a normalization of these very, very high levels of inflation that we've seen in the last 3 months.
Will high oil prices cause stagflation?
Well, what we are seeing with the conflict is a stagflationary shock. There is no debate about it. It's a supply shock in the sense that we were dealing, if you will, with the aftermath of COVID, and now comes a conflict that materially impacts commodity prices because Ukraine and Russia are major producers of various kinds of commodities. Russia, of course, being the main supplier of gas to Europe. That supply so far has not been stopped, but there are now sanctions coming in the direction of oil supply. Ukraine and Russia are material producers both of other commodities like wheat and also minerals that will get in short supply to many countries, and this is a stagflationary shock to the world, or certainly to the countries affected. And the oil price was on the move anyway upwards, but got a bump, of course, because of the conflict. Oil in and of itself is not the only factor here. It is really a sort of an array of commodities that are being affected, and that in and of themselves, including the sentiment shock, if you will, that we're seeing because of the conflict, is indeed a stagflationary shock that will mean lower growth globally and especially in Europe.
In the past 2 months, the stock market, especially the US market, was off to a choppy. As we are heading into the second season, will the stock market perform better? Why?
I think we will see a rebound in equities going into Q2. As I said, we've gone overweight. We have here at Credit Suisse somewhat of a contrarian way of constructing and taking views into equities. So when markets have gone down, as they've gone down really meaningfully in the first 2.5 months of this year, S&P down by something like 6.5–7%, Nasdaq materially off its high. We take the other side of these things, and we've decided to begin buying equities. I think markets will stay volatile in the short term for sure, because we need to sort of digest the negative news flow, especially from the commodity price side and the conflict in Ukraine. But the fact that the Fed has been confident enough to begin starting to raise interest rates, and they've commented that the US economy is resilient, is actually on average good news. And I think we will see fiscal support measures for consumers in this environment, and that is also good for markets. So for me, the conclusion is we're going into a better second quarter than how the year has started. And I also think especially in China, and that's why we've decided to go over where China has reacted to the very negative equity market developments that have taken place in China. And as you know, they've announced what we think are market-friendly policies. And therefore, I think we can see a recovery pretty broadly in the second quarter of this year in equities, especially, as I said, in the US and in China.
You said that we are in a new world order. What does this mean for the stock market?
Well, a new world order is a term that I think as we go further into this year and next year and the many coming years, we've been sort of looking at for several years. We've called it a multipolar world, but this conflict is accelerating the emergence of a new multipolar world. And a multipolar world really means that there are various, in this case, larger countries around the world, and the three main ones, plus another region which I shall comment on, are really the United States, it is China, Russia, and it is indeed the European Union. There are other major countries around the world as well, but we are no longer in the globalized, interconnected, interwoven world as we come out of this conflict in Ukraine, hopefully as soon as possible. We are in a new world order where these regional blocks will become stronger in and of themselves. I think the cooperation between some of these regions, certainly now in the direction of Russia, given all the sanctions, etc., will show and herald the beginning of a new world order where regions will look more for their own interests. And as investors, these are absolutely crucial considerations to take into consideration when you construct your portfolio. One thing for sure is that, as I commented before, we are going more into a stagflationary environment for the global economy. Doesn't mean that the economy is going to be necessarily very bad, but it just means that we will have lower growth and higher levels of inflation because especially of the commodity price impact. And at the same time, central banks are going to raise interest rates to fight inflation, and therefore we are indeed going into a situation where we may have sort of a limited time span in this economic cycle still, but with the backdrop of a new world order, and that is these central banks of the United States, of the ECB, Chinese central bank, etc., will have to look more at their regional economies, their regional situations, and it will have consequences for the global picture that we have not been used to in the past.
You have already mentioned several central banks that have different monetary policies. The Fed raised the rates, the ECB kept the rate unchanged, and China's central bank lowered the rates. How will diverging monetary policies influence the world?
Well, the main consequence, in my view, will be through a mechanism of how currencies behave. Once we get into a world where central banks are not synchronized in the way that they conduct monetary policy, the first mechanism is through currencies. Concretely, as we've seen also in the recent past, is the fact that the US dollar has stayed really very strong, simply because US assets, US cash, become more attractive for foreign investors, and as a consequence, it floors their currency and or put it under upward pressure. What we will also, on average, see because of different monetary policies is more and more of a desynchronization of the global cycle, with more regional cycles, maybe also as a consequence of the New World Order, as I said. But that will transmit in general into bigger currency fluctuations, and of course transmit into different growth pictures, with clear consequences for the way that you conduct regional investment policies. Concretely, as I have outlined now, we've gone overweight the US simply because we believe they're better shielded also from the conflict, and at the same time we've gone overweight China because they are, if you will, if anything, losing up on monetary and regulatory policies to support their economy, and that will transmit into positive equity backdrop in our view.
What should the investors do while facing a new order?
Well, as we move towards this multipolar world, financial markets and economies look set to become less integrated in the longer term. I think the first key conclusion that investors should draw is that their strategic asset allocations should include larger, what we call home biases. So you need to raise your exposure to either the US or to European Union or to Swiss equities, depending on where you are and where you live. Why? Because of potential higher fluctuations around currencies. Investors will prefer, in our view, assets closer to home versus other areas, and other areas in this new world will have to carry a higher risk premium. The new world order might also lead to higher risk premiums in regional markets, depending on fundamental developments there. We're not experiencing a breakup, if you will, of the global economy, fundamentally speaking, but we are talking about, if you will, a more and more detached regional picture, where topics like nearshoring, so bringing production home, making sure that you have availability of critical components for your manufacturing industry, will have to happen closer to where you are. And I can give you two very concrete examples. So what the pandemic has made clear is that because of supply chain issues, the provisions of something like semiconductors has become a major problem for many companies. And that is because companies around the world have made themselves dependent on too few providers of semiconductors, especially providers from Asia. And German car manufacturers, US smartphone producers simply cannot afford or allow themselves to be exposed to so concentrated producers in a potential situation where supply chains get cut like they have done now. And that may mean we see production of semiconductors in the US. We will see perhaps at some point in time semiconductor productions in Europe. And this is a consequence of the pandemic and the supply chain problems. Concretely, in the New World Order, it is obvious to everyone that Europe has made itself too dependent on gas provisions from Russia, and will look to other providers to fill that gap, not be dependent on or overly dependent on just one provider of one particular very critical commodity like gas. And therefore, you will see, as we've already seen from headlines, that Germany will look to other providers in the Middle East, concretely Qatar, which will supply Germany with liquid natural gas. And the same probably is going to happen down the road with the United States playing a more critical role in the global provision of gas. And that will herald the emergence of new investment themes and accelerate existing ones, like we are capturing here at Credit Suisse in what we call our super trends. Lastly, I think the New World Order is something very important for cybersecurity and security and defense in general. It's very clear that for the first time since Second World War, we now have a major war in Europe. And Europe will have to rethink its foreign policy, its energy policy, and its security policy around military and defense. And those are tectonic shifts in the fabric of the Second World War era, which was first signified by the Cold War between the Soviet Union and the rest of the world, or the Western world, sorry, and to be, if you will, followed by what we now know are sort of maybe 30 years of peace after the Berlin Wall came down. But the new world order looks different. We are no longer in a phase of peace as we now have a major war in Europe. We're in a world of conflict, and we're in a world where regional powers will assert, if you will, their influence and of their feel of geopolitical security and sphere, and that has major consequences, in my view, for investments and for economic growth in the future, which, in our view, a thematic approach is becoming more and more important for investors to think about.
You expected the global economy to grow by 4.3% in real terms in 2022. Do you want to change your prediction? Why?
Yeah, I mean, we are reducing our growth for global, or our forecast for global growth. We expect real GDP growth to be 3.6% now. Manufacturing, on the manufacturing side, the global economy is still supported well by strong demand of goods, especially in the US, and by strong labor markets. Also, the gradual lifting of COVID restrictions pretty much everywhere in the Western world is supporting the service part of the Western economy. So both of these factors are really very positive for growth. However, we've downgraded our forecast because of the risks associated with the Ukraine crisis. Energy prices are the main reason for this, and we do believe that the prices will stay fairly high and volatile, and the higher expected inflation imply faster monetary tightening, as I've said, from the Fed than planned, and they've signaled this especially also yesterday. And this conflict is a supply shock to the global economy, especially for Europe, and therefore it's unavoidable that we won't see lower growth in general. But I still believe that growth in the totality of things is quite solid, not as strong, however, as when we started the year, of course, because mainly of the Ukraine situation.
Which area will drive the global growth? North America, Asia, or Europe?
Well, so the two key drivers of global growth are the United States and China, with still very solid growth outlook. China most likely, in our view, will grow by 5.9% this year. And the US is also sort of pretty well anchored around 4% growth levels, and that is enough to keep the global economy from not sort of going into an outright growth recession. And not to talk of a global recession, we're quite far away from that. But the negative effects from the European situation and European growth is more than compensated from those two areas. So the strong growth areas are US, China, but also I would say in general still emerging markets.
How do you think about the Chinese economy this year?
Well, so China has announced ambitious GDP targets of around 5.5%, and that sends a strong message of growth stabilization. China has traditionally exceeded its growth targets, and as I said, we expect China to grow by 5.9% this year. We've held this view since the beginning of the year. The key pillar to delivering this growth are focus on new energy sources, digital infrastructure, traditional infrastructure, and a stabilization of the housing markets, and attempts to boost household consumption from the Chinese government. Our economists expect that this there the official target can be achieved or even exceeded, and we believe China will need, if you will, a stable and transparent regulatory framework in order to boost fixed asset investments even further. And therefore the reduction of the regulatory, if you will, interventions or crackdowns, it was much needed and was seen as, for us, as a very positive sign. And if you will, the Russia-Ukraine conflict introduces some downside risks to the global economy and also therefore to Chinese growth, because China is very dependent on global growth. But this we think is manageable and predominantly comes through higher commodity prices.
In terms of Chinese stock market, what's your prediction?
So we've gone overweight China and the Chinese stock market last week. We took a quite cautious view already last year or after the strong rally, but Chinese equities now look increasingly attractively valued with good EPS or earnings per share growth. For the next 12 months, we see sort of a PE around 11 for Chinese stocks, which is very attractive compared to some of the developed markets. And therefore, we see it as now fairly valued, if not slightly cheap, certainly relative to other areas. And after the strong volatility, which, I mean, in some cases and days last week were some of the sharpest swings we've seen since the financial crisis, actually, China introduced sort of more market-friendly policies, and that led us to believe that we could see a good upside potential for Chinese equities in this environment. So we went overweight.
How do your clients think about the Chinese market?
So our clients in general have, I would say, on average, been quite open to investing into Chinese equities. I mean, our client base, of course, is very international. It is not just, if you will, Swiss investors, just simply because we're headquartered here in Switzerland, but we've had for a number of quarters last year and the year before a focus on China based on mostly, as I said, new economy oriented stocks in China, clean energy stocks, healthcare stocks, and that has in general been something that has high interest for our investors, and they've certainly recently, from our move last week, been very interested and encouraged to invest into Chinese stocks, because China is a major global economy and offers an immense amount of variations for investment. So in general, a very high interest and positive interest in Chinese stocks from our clients.
All right, thank you, Michael. As Michael discussed, the two key drivers of global growth this year are the United States and China. Looking forward, we could see a good upside potential for China. That's all for today's show. Thank you.